Joining me today is Noel Smith of Convex Asset Management. And the reason I want to have Noel on today is because there's all sorts of interesting things happening in the volatility landscape. And so I wanted to get a real practitioner on to help us kind of navigate some of those things that we're looking at and just kind of try to get a better understanding of the landscape here. So Noel, how are you doing?
Doing good. It's been a good day for us so far.
That's awesome to hear. So could you give us a little bit of background? I know from your Twitter bio there, you were a former market maker. You're at Noel Convex, by the way, so please check out his Twitter. But just tell us a little bit about yourself.
Yeah, I started out as a floor trader on the floor of the CBOE a billion years ago. And I was one of those guys standing in the pit that would make markets. And that kind of progressed from me figuring out what time, the market opened and then where the bathroom was to, doing okay and then backing other traders. Then at some point we had really a trader in every pit. And then that kind of progressed into having guys, in the euro dollars and the notes, guys on the Amex, guys on the Philex, and kind of, backing a guy in wherever we thought there was some kind of edge. And I grew that business to probably back to around 100 guys in aggregate over the years. And then we were also the seed capital behind what was Getco at the time. Okay. And that is now kind of morphed into Virtu. I have nothing to do with Virtu, but Getco bought Knight Capital when Knight's algo went crazy. And then Knight kind of morphed into what is now Virtu. But, market making, market taking, and, kind of the evolution of all these things. You start out as a market maker and you just kind of give your bid and your offer. And then you kind of think to yourself, well, why is this individual trading with me? Or why is this pension fund trading with me? Why is their broker Goldman? Why is this other broker, Englander or something like that?
Right, that's fascinating. I find that a lot of the guys now who seem to be the best traders had that kind of floor experience. There's something about just the nature of understanding kind of counterparties face to face, I think, that you learn, and a mentality you learn that you kind of don't pick up when you're staring at a screen all day.
Yes. And it's also very hard to teach. There's a finite amount of information you can learn in the English language, right? But that doesn't mean you speak well, or in the options world. So you can learn whatever there really is to learn about options, but that doesn't mean that you necessarily execute properly.
Right. That's the other thing. You have a great idea, particularly in options, you just express it the wrong way and you lose money. That's probably the most frustrating thing about it sometimes.
Totally.
So tell us a little bit about Convex and what you're doing now and a little bit of background there.
So Convex is really the expression of something I've been thinking about since probably 2003, 2004, which is taking some of the best practices from the prop community in Chicago and really bringing them to investors. So the spirit of our hedge fund is to use ideas that investors don't really ever get a chance to see. And most of our strategies are vol based, and you don't necessarily have to express an idea that is vol based in volatility. Say you want to be long Apple, well, you can do that by being long the call, short the put spreads, whatever. Or you can just be long Apple, and maybe you get your information to make that decision from the options. So there's just a million ways to make it a decision. And we tend to get our ideas from the options landscape, but it's not always expressed in the options landscape. Now, I can go into the strategies if you like, but depends on what you want to talk about.
Sure. I would say that kind of hits home here. A lot of our subscribers are actually futures traders. We get a lot of futures traders. They read the options market to understand, where they want to put their stops out or where they want to buy and that kind of thing. And so your strategies, are you primarily, so you trade all individual equities, S&P, kind of whatever goes?
Trade futures, options on futures, pretty much everything CBOE, but a lot of products. There's some products that are hot for a day or two, and products that are hot all the time. It's to kind of fill in some of the blanks. So as a market maker, what you're doing is you're providing a bid. I'm dollar bid in a $1.10 offer on this option. And then at some point, it kind of dawns on you like, well, why is this guy paying $1.10? It doesn't seem like it's worth that much. And then you realize, well, he knows something, or maybe he doesn't know something, and it's just a really good trade. And then you have to kind of suss that through. And then you think to yourself, like, okay, well, I can just, I'll pay $1.05 because these things are probably my fair value Theo at a $1.05 is probably wrong. Maybe it's higher. And then, the gears start to grind and the ideas start to come. And then you mature from being a bid offer guy, trying to sell out your hedges in the middle, to thinking, okay, well, what if I take the market? What if I'm also a $1.10 bid? What if I'm a $1.09 bid as opposed to being at a $1.10? And then I can kind of move my markets and then express my ideas that way. So to me, it's the kind of logical progression of things.
That's fascinating. So on your screens there in the background, I know you're not making markets anymore, but those are some pretty heavy duty. They look like what I would see as kind of on market maker, sort of volatility traders desktops. Is a lot of the foundations of your strategy now, they seem like spurred on by the market making, background you have, but if we kind of dig into the strategy just a little bit, just to get a kind of overview. I know you said you run a variety of different strategies, but are you primarily trading volatility then?
Yes, because I feel like, is again, if you're trading Apple, just stock, right? You still, even whether you do or don't, you have some kind of convexity component implied in your position. And from that perspective, even though you don't necessarily have on a volatility component, I could easily argue that you kind of do. Because you're trading something for something else. So is it better to have a 0 date expiration option in Apple, or is it better to have 10,000 shares of Apple? Only. So we're trying to algebraically solve for different variables, what we think is optimal for whatever it is. So to answer your question, talk about the strategies. You said you had a lot of futures guys. So one of our strategies is we're looking at bond volatility. So we're looking at the 10-year notes, and you have a yield curve, right? That goes something like this, probably. And then within the yield curve, we all know this, you have a volatility surface, and we're only focused on the volatility surface. So what we're looking at is the theos and the volatility surface in the 10-year notes. And then we create our own theos relative to what the market has. And then we basically smash, mountains and buy valleys. That's kind of the gig. And sometimes we're right, sometimes we're wrong. So going into like a GDP or something like that, you'd say, well, the bond market says that the straddle is worth, 20 ticks. It's not dollars, it's ticks. And maybe we think that it's worth, less. So we sell 20 ticks, or the other way around. You're making a market one way or the other. And the software behind me isn't that different than market making software. We go out there and we express our trades in vol space as opposed to price space. So if I want to buy a dollar option, well, that could be reflected in a 30 volatility. But the dollar is a function of the price of the underlier. So I'll say, okay, I'm 30 bid. I don't really care if the stock goes up a buck or two. I'm still 30 bid in vol space.
Right.
And that's kind of how we would express that. Yeah, and that's what a market maker would do. They're not really dollar bid at $1.10. They're 30 vol bid at 32 vol.
Right. And that's where I think a lot of people. I don't think there's enough of that understanding in the retail side of the equation, right? Because everything is very price based when you're looking at your interactive brokers, your thinkorswim, or whatever it may be, and people are constantly thinking that price backs out to volatility, but really the guys setting the prices are talking in vol terms, and that backs out to price. It sort of is the back way that I think a lot of people kind of think about it. And that's that's kind of one of the big differences, I think, between the retail community and the professional community.
And I guess another big difference in, this is not something that, I often talk about, but it's kind of, burned into your brain on the floor, at least. Whenever you buy something, your immediate next decision is, what can I sell against it? So, if I buy a straddle, I'm immediately thinking about where can I lay that risk off. It's never going to be risk-free ARB, but some kind of ARB. And, I still carry that forward. So when I'm buying straddles in ZN future options, I'm then looking out in time in a different, tenor, where can I sell that volatility in a different thing? And I understand that there's basis risk there, right? Like some of my vol can go crazy, the vol can go not crazy. Fine. But that's a risk that I'm willing to accept.
Are you finding in this current environment that the sort of the relative relationships that maybe you've held for 10 years ago, stocks go up, bonds go down, or vice versa, or vol goes up and market goes down, or whatever. Are those relationships? I mean, it seems like they're probably getting stressed, or they're acting in different ways, or behaving in ways that are not really what we've seen over the last several months and years, if that makes sense.
So we could talk about that for an hour, but we have 4 strategies. And the point of us having 4 strategies is we can kind of toggle, because I don't think that, any one strategy, maybe other than high frequency trading, works all the time. So if you have a dispersion trade on, or you have a relative value trade on, or whatever else, say you're the lumber guy, a year and a half ago, well, your lumber trade is probably really hot, but that doesn't mean that lumber is inherently a better product than gold or hogs. You just are in an environment where lumber's going crazy, and now it's your time to shine. But once that stops, maybe that paper dries up and your opportunity set really dries up. So that's kind of why we have the ability to toggle through several strategies, because like correlation trading is something that we do. I did that years ago, and then it kind of died, and then we kind of revived it. And it wasn't really the trade, it was the marketplace. So to answer your question more directly, these relationships, like, bonds go up when stocks go down, or rates do this, do that. Those relationships have been around for a long time. So it really threw a lot of people for a loop when those relationships that are like maybe, anti-correlated started becoming positively correlated. Stocks and bonds both down at the same time for a long period of time.
Right. It's a beautiful segue into kind of one of the first things that I wanted to get your opinion on here, and that is correlation. And I'm going to try to bring up my screen here. I'm working on trying to say less. I realize when I edit my own videos that I say it entirely too much. Let's see here. All right. So one of the things that we've been talking about, which sinks into a couple of different things that I really want to get your opinion on. This is the SIBO correlation metric. And maybe you think that this correlation metric by and of itself is kind of useless, and I'd be happy to hear that. But we have some interesting things happening in the volatility space. And this is correlation, which is at lows not seen since, basically 2000, late in 2017. What do you kind of make of this as a guy who runs a correlation strategy? I've had a hard time estimating how big the dispersion flows are, or how big the flows related to sort of correlation are. Are they enough to really impact the market significantly, or is this measurement kind of a reflection of just other behaviors in the market? So what do you kind of make of this in general? And do you have any insights you can shoot over to us?
Sure. So I am not here to talk my book, but talking a little bit about it will kind of explain the answers to your questions. So when correlation is really low like this, another strategy that we trade is basically being short vol or short VIX. Mm-hmm. So when nothing is going on, what do? It's a good time to collect premium. So what do you do with correlation down here in 2017? Using 2017 as a template or as a map, if you took off the position at the bottom in the 2017 on your chart, you missed a lot of opportunity. Mm-hmm. It continued to work really until January. So a lot of people basically didn't add enough size, or they took off their book trying to time it. And they really threw away about 6 months worth of P&L. And that P&L did reverse in January going into 2018 into Volmageddon. But the correct way to look at it was really more in isolation. It's so easy for you to look at where was something relative to something else, which is the point of a chart. But if you look at where is realized vol relative to where it's implied, where is realized correlation relative to where it's implied, it's probably still a do. And we actually added some size yesterday, which a lot of people would be like, why would you add size down here? But going back to 2017, if you sold VIX at 11, a lot of people would tell you that you're reckless and crazy. But what if I told you that VIX or S&P vol was realizing 6? It was still a do. That spread was still wide enough that you could mathematically and mechanically trade that for profit.
Yeah, it's a great, sorry, my screen's kind of going wacky here. You bring up a fascinating point in the realized correlation between versus sort of the implied correlation. This is actually from our founder's note this morning. We write this daily note, and this is sort of what they call the variance premium. You know this better than I do. Basically, 1 month realized volatility versus the VIX, and that was sort of the point that we made this morning. Is that realized is at a 9, and so the VIX at 13 or 14 or whatever it was yesterday. If you look at that long-held relationship and say, okay, 3 kind of points difference between realized volatility and the VIX, then the VIX should be at 12. That's reasonable. That's kind of the exact same thing you're saying, just in this correlation space.
Yeah, if you're just saying that Y trades over X by Z, right? Maybe that number is 3.5, maybe it's 30, doesn't matter. And then you just say, okay, I have some kind of boundaries around this. So if Y trades 5, that's too high, I'm going to sell some Ys. Y trades 1, that's too low, I'm going to buy some Ys, because that function is the spread. And whenever you're doing something in vol space, not always, but often, it's relative to something else. Mm-hmm. And the relative trade there is still good enough for me to say that you should have it on.
And this is the long-term realized volatility. 1 month realized volatility is in green. Sorry for that background noise there. And in October of 2017, we hit what I think is the all-time realized volatility low. I think it was 3.5. There seems to be a seasonality to this, and to your point later, you missed a lot of P&L. I got a lot of questions coming out once here. Do you see a reason for the seasonality where realized vol seems to kind of hit its lows in the October timeframe, November timeframe? I mean, you can see the cycle here, right?
There's 2 quick analogies. You can think of, gamblers at a table. I live in Vegas, but ironically, I don't gamble because I can't stand giving up edge. It's just, that's the trader in me. So when I know the table has an edge, I can't do it. But anyway, so if you populate your table with people that are there to likely mathematically lose, then they do all lose in time, which everybody does. Then they go away. either they run out of money or they're pissed off and they leave.
Mm.
And then you wait for new people to come in. And that's the ebb and flow cycle of this stuff. So, and again, if you have no book on because you've lost your book, who cares about the hedge, right? So puts and hedges in general in the last 18 months have been terrible. They're not even bad. They're just straight terrible. Yeah. So a lot of the money that has been allocated toward the hedge book has been evaporated. So a lot of people took it off. And so that's part of those two cycles, right? You need more suckers at the table to engage. So you need the VAR swap community to sell VAR swaps. You need the vol ETPs, VXX, XIV that doesn't exist anymore, or the nerfed SVXY. You need those products to add more notional Vega so that those things can become dangerous again. And they're not. They're more dangerous now than they were a year ago, but they're nowhere near at the levels that they were in February 2018. So the needle is not banked in the red. In other words, if VIX goes up 100%, the inverse products will not go down by the same magnitude that they did because of forced covering in the last 15 minutes of trading in February 5th, 2018.
Right. And you had an interesting chart on your Twitter feed about that. I think it was Morgan Stanley put out a Vega notional kind of exposure, which brings me to another question. Also, if anyone does have questions, I see someone just put in the chat. If you do have questions, put them in the Q&A button there, and we'll hopefully have some time at the end to kind of get over to this. VIX call open interest at the moment, this isn't related to the ETPs necessarily, or ETNs rather. VIX call open interest, I don't have the chart up here, but it's at record highs, or it's rivaling 2017. There's also a tremendous amount of S&P put open interest, and I don't think you can explain all of that through kind of just zero DT and shorter data options. But what do you kind of make of that size that's built up in the VIX? I mean, what do you think is the driver of that open interest?
They're two separate questions, because VIX is it more of a VAR swap, and S&P puts are more of a they have a strike component, right? So if the market's trading at 4,000 and you want to hedge, at the 3,900 strike, right? Then you go out and you buy your 3,900 puts. But if the market then goes to 4,500, your 3,900 puts are worthless. So you have a component that is diminishing at an accelerating rate. Versus in VIX space, you can say, well, VIX at 20 is a certain percentage of the standard deviation of the move for the next year, and it will be in 3 months. So it's a cleaner way to buy that vol than just saying I'm going to buy the 3,900 puts, because of the strike erosion, which speaks to the charm and the Vanna concepts that I know that you also talk about. So there is a difference in those two, because if vol goes to 20 and you own the 20 calls, that's different than if you own the 3,900 strike puts and the S&P, but we're at 4,500, so they're not ever probably going to work. So those things are probably just going to go to money heaven. So those two things are different. And the reason there's so much open interest is because those levels have come down a lot. And a lot of those puts that are there as a legacy are an artifact of previous hedges. And they also have to, they were bought for $4 and now they're 4 cents. And so if those things do get reinvigorated, they will act as a vol suppressor on the way up.
Mm. And so when it seems like there's a fair number of chunky VIX call positions that go up. And I take those to be, the kind of 50 cent guy, right? Where, for those of you who don't remember 50 cent, he would buy these 50 cent, these calls that cost 50 cents, right? And he basically just kept repeating it until one day finally things broke and VIX, spiked and made a whole bunch of money, and then he kind of went away, right? Are those the type of trades that are they speculative trades in your view, some of those hedges, or, are they actually hedges rather than speculation, do you think?
Well, I know, so I don't have to guess. They are hedges.
Okay.
So when you have a $20 billion book, mm-hmm. and you go out and you buy, 100,000 50-cent calls, is spending $5 million worth it if you can use that as a marketing adjunct to your investors for your $20 billion book? Yes.
Yeah, that makes sense. And that, so I guess one of the things that I have a hard time kind of like cross-referencing in my head is the record open interest, which, I think in general, when I feel like there's higher open interest, you would say, okay, that it seems like there should be, larger amounts of notional exposure. I don't know if you're familiar with what's on your screen here. It's the Nation Skew Dex, and it looks at put skew. I think it's a 1 month at the money put versus a 1 standard deviation down out of the money put. And so, when you look at this implies that obviously puts are just getting sort of trashed, and those put values are, and those charts are kind of making the rounds. And I know some people are saying, well, rates are higher and it's not apples to apples and all those kinds of things. I mean, how do you look at the relative price of volatility now? I know before you talked about, realized and implied, but do you think that this is unnatural, kind of, if that question makes sense, or there is a level here of exposure where we're sort of pushing on a string based on the fact that these put values are all sliding so much lower?
The component here that's often not discussed is time. So if you look at price, you can say, okay, well, these VIX calls are cheap because they're $1, and they haven't been this cheap, which is call it a 15 vol. That is as cheap as they've been in the last 18 months. But what happens if our dollar doesn't move for the next 30 days? It's magically turned into zero yet again. So it's not just price as a function of where it's been, it's also a function of time. And most people know that vol has a stickiness component. It tends to cluster. That goes into the Garch modeling, right? So you say something like, well, what's the weather like tomorrow? It's probably like it is today. Right. It might rain, but probably won't if it's not raining today. So that kind of concept is mathematically borne out into this, which is to say that vol can be sticky at low levels, which is that a 12 vol is not necessarily cheap. It's cheaper than what it was last month or last year, fine. But as a function of time, it's probably fair.
That makes sense. And so the way that, turning that slightly then, if we were to just get a small brief sell-off here, God forbid we go down a couple of points, that vol is going to relatively spike, right? And if I understand what you're saying, obviously there's these kind of feedback loops that are occurring and help to push volatility lower and lower. And so if we were to get a move down here and the VIX kind of just jumped on us a little bit, that would mean that volatility is, and granted there's a bunch of other factors, but that volatility is relatively rich, right? And so you're likely to get a response from volatility sellers or whatever based on that volatility clustering that would kind of suppress the first move, if that question makes sense.
It does make sense. I think your answer is embedded in your previous question, which is if we have a lot of VIX open interest, that means people have these calls, right? So if you own the 20 calls and you bought them for $3 months ago, and now they're worth 3 cents, and then the VIX spikes and you're like, wow, my 3 cents turned into 50 cents. I'm pretty happy about that. Yeah. So now I'm going to go out there and hedge some of this, take some of my money that kind of got gifted back to me, and that ends up being another reflexive loop. So it's a function of the behavior of crowds, which is something you learn really easily on the floor. I know that you weren't talking about yourself, but this speaks to the whole like gamma suppression and charm. And let me think about this more clearly. If you're a floor trader, right, and there's 10 guys in your pit and you've been on vacation, and for the last 5 days, brokers have come into the pit and done nothing but sell volatility, and you haven't been there. So now there's 9 guys in the pit that all are just soaked with gamma. They have tons of it. So they keep lowering their price. And now you walk in after being on vacation and you're like, wow, gamma's really cheap. I'm going to buy some. So you don't have the same problem that they have, because now they have to carry that theta every day from a higher level. And you can walk in advantageously and buy at the best prices, or the flip side, sell at the best prices. And knowing their position, or knowing the open interest of the 9 guys around you, is helpful. It's not necessarily, doesn't mean you can make money necessarily, but it's a statistically more likely event than having just no awareness or being guy number 8.
It's the positioning aspect, right? That
yes. Yes. So if there's a ton of open interest in VIX and everyone's long a bunch of these calls that are almost worthless, or if they become worth something yet again, hedging activity will come and act as a vol suppressor yet again.
And then until something sort of breaks that cycle, which, obviously in 2017, you had the issue of every time we got like a little kind of local volatility pop, right? Then everyone said, oh, great, finally I can sell this vol because, we've had a VIX of 9. So a VIX of 12 is really great. I can sell, these ETNs against it. And then finally that positioning just broke things, right?
Yes.
Still
but I would argue that, so a lot of people think that it was the notional vega that caused it. So I was trading it live in real time, and the best contemporaneous indicator I had at the time wasn't really the volatility or the vega on it. It was the borrow aspect of the product. So in the broker community, they were shopping around the risk reversal or the reversal, right? So what was happening was, reversal is really a function of interest rate and how much the borrow cost is going to be. So the market was like 25 cents, and then it was being shopped at 27 cents, and then 32 cents and 40 cents, et cetera. So if you know kind of how options in the create redeem process works within ETFs, you know that shares are getting more difficult to borrow, and therefore the reversal is starting to expand, and then people are trying to buy it. So what that means intuitively is that this thing is going to become more volatile because there's less of it.
Do you think I hadn't actually really heard this angle, so it's really fascinating. But do you think there was? I'd always thought that it was known certainly by the institutional community that there was this level at which I think the VIX doubled, but basically in the prospectus it says, look, VIX doubles, the product XIV is gone, right?
Yes.
So I've long thought that, hey, people knew this was existed. There were a lot of people who held basically very deep, that were betting on the extermination of that product sort of imploding. At what point, or maybe this point didn't exist, but at what point do you think it was like, hey, we're almost at that level where this XIV thing is going to blow up? Like, we could just give volatility or the VIX kind of a little bit of a shove here and spark it a little bit higher. Is that something that occurred, do you think, or is that just my kind of conspiratorial mind working?
I don't know is the super duper real answer, but I think that it was a little bit of both. I think that there was a very strong awareness of what that tipping point would be. And I don't know that anybody specifically did the tipping, but I think that once the tipping started, everyone put their finger on the scale to just wail on it. So right. if you were looking at the net asset value in XIV or SVXY, you could see it in real time. These things was like, $90, $70, $40, $10, and these things are just getting wailed on. And you're just like, you're watching this thing like, what? And this is happening in the space of like 15 minutes. So if you remember that day, the products were all down very large going into the close, but they didn't die until after the close. So everyone knew how much, and the front running community knew how much futures needed to trade in order to rebalance these things. And they just front run it. It's an obvious and easy trade if you're poised to do it.
Right. And
when
I'm sorry, go ahead.
I said, when oil went negative, if you called up your guy at Cushing and said, hey, listen, I need to take physical delivery of a few, million barrels. Can I soak up some space? If you were able to figure out physical space, you could buy as much oil as you had space for at negative $35. It's great money.
Where are you going to store it?
Where are you going to put it? Great. Here's your oil. Now what?
That's too funny. So I want to pivot slightly back to Dealer Gamma, and we had some notes that we sent over and talked about, and that's a lot of kind of how we model things or look at the world. And good, bad, or indifferent, I wanted to get your sort of take on how you look at that kind of positioning gamma, and you're well aware of all the metrics that get put out here. What sort of, where do you think it holds weight and or doesn't, or what are the aspects of that you may pay attention to, or is it just kind of in general something that's like nice to know, but what's your sort of feeling on that? And I duck with this question because maybe you're gonna be like, this is all useless nonsense, but so you got to ask the question, right?
Yeah, and I think that it honestly it speaks to your your willingness to because we didn't talk about this ahead of time, so nobody knows what I'm going to say, and your willingness to kind of be pushed back on. Yeah, exactly. So your willingness to do this live really speaks to your integrity. I think that the structure of the trade has merit. It's not, it's not working all the time. We both know that sometimes these things don't work. And what percentage of the time does it work relative to how you would model it is the real question, I think. So if you go out and buy a straddle and you say that my straddle should hold something like 1 standard deviation of the time, that's a more specific question that I think that's where I think the root of this should really be. So if you're saying that there's this probability, there's a probability cone around this event happening, and that I don't think that the cone will be violated to the up or down, and then you assign some number of events to that, n number of events, I think that is where the value starts to be added. And so you're not saying this can never happen or that will never happen. You're saying this is the more likely event, and all else being equal, this is what's probably going to happen. And I think that's where it does to add value, because if there is, extraneous exogenous news all bets are off, right? There's new information, or maybe there is a shift in the Fed fund futures, and then allocators start coming in and, just VWAPing a stock all day long, or VWAPing the SPOOs all day long. And they don't care about your gamma levels, right? They need to go out and buy $10 billion worth of stuff, and your gamma levels be damned. But in absence of those types of macro events or news events, and nothing else is going on, and guys are just kind of just doing their own little thing, they do act as a sticking point. Going back to my pit example, if everyone has a certain amount of gamma in the pit and I don't, and I know that they're going to hedge around this certain level because they all have to cover their theta. So if the collective theta in the pit is $100,000 a day, so I can mathematically compute that at the stock down or up $100,000 in break-even P&L, there will be some hedging activity because guys can't afford to waste that theta. Then I can reasonably do something at that inflection point. And that's really pit trading 101, maybe 102. And it's the same concepts, but with different words.
That makes a lot of sense. So if I was to give you, a single stock example, I'd be curious how you look at this. You talk about meme mania and gamma squeezes and all these kinds of things. How would you sort of, and I think it's harder now because it's all electronic, obviously, but how do you sort of know, or how do you measure, my guess is with implied volatility, but how do you sort of measure, like, okay, this is a situation where clearly, one of the dealers or whatever is short gamma and, Chipotle or something like that, and the chase is sort of on. What are some of the signals you may look at or go like, hey, this is kind of a long volatility situation based on positioning of counterparties? Sure.
So again, I don't have to speculate. I can just tell you what I did in real time. That might probably be more entertaining and
yeah, 100%,
certainly more specific. So using GameStop, and I had other positions in the meme stocks other than GameStop, but using that as a template. I was short GameStop at 32. I covered for a loss. I was short GameStop at 47. I covered for a loss. And I was short GameStop at 67, covered for a loss, bought it at like 70 something and rode it to the top. And then I sold puts when the straddle was like $400. So it was a gigantic winner for me, but I had no idea. So exactly answering your question, when things become so irrational where you start to figure out people are blowing out, then you pile on. And that's when it gets extra violent. That's when, the counterparty goes from having like a bad day or maybe a bad year to being out of business.
Yeah, I think it is pretty amazing that through all that, because there's only 6 or 7 now large, options market makers, and I think Citadel's like half the flow, right? And it's pretty remarkable that through all that, wild, crazy times, like the sort of those entities never seem to really come under stress. At least it was never sort of publicly made there, right? And I do think that's kind of a testament to how good those liquidity providers are. I mean, I think a lot of people, admonish them a little bit, but it's pretty impressive that things work pretty smoothly through a lot of that.
Everyone thinks that they have everything figured out at all times. And I am in no way denigrating these people because I know a lot of them. They are smart people, but to assume that any organization or any small group of people have everything figured out is also giving them too much credit. Some of these organizations definitely lost money the first day of GameStop. And that's why you saw the straddle expand from being high to being insanely high.
Right.
So in order for you to continue to make money in GameStop, I think it had to break $1,000 or something like that. And so basically the attitude on the market maker standpoint was, you got me once, here's your new price. You're not going to get me again.
Yeah. And do you think that sort of the echoes of that, I mean, it feels like that to me, that the echoes of that meme mania kind of persist today, where it seems like there's a lot more jumpiness in pricing. Like the vol of vol seems to be, or the vol volatility pricing. I don't know if I'm saying this the right way. It just seems to happen a lot quicker. Like, okay, this name looks like it's going to squeeze, and then suddenly, like, calls go from 20 vol to 100% or something like that. Do you think that there's that echo in place still, or do you think that the price reaction to movement is more or less the same as it's been?
It is definitely not. It is discontiguous. That's where the Black-Scholes model really falls apart. And if you think about this from an intuitive standpoint, I've used this analogy before, but I think it's a decent one. Say that you, Brent, are a BMW wholesaler, right? And I call you up and I'm like, hey, Brent, I got 2 BMWs to sell. And you're like, okay, fine. I'll pay 50 G's for them. Fine. Now you own 2. And I call you back up 10 minutes later. I'm like, I got 5 more. You're like, what's your bid now? You're like, I don't know. I just paid 50 for 2. I'll buy 4 for, 48. Fine. Now you own 6. And now I call you back up 10 minutes later and I sell you 10. You're like, dude, why didn't you just tell me you had all these cars? And then I call you up an hour later. I'm like, I have 10,000,
Mm.
so your price isn't going to be 50, 49, 48, 47, 46, right? Your price is going to be 50, 49, 45, 35, 2. Because at this point, you think that all BMWs are radioactive or whatever else. You have no idea what's going on. But you're making a market such that you feel like you can't lose. And market makers do the exact same thing.
Right. The number of new products coming on, and I guess this is translating to we're transitioning now to kind of zero DT, which I wanted to ask about. There seems to only be new products and more access and all these things, which I think is great for the average trader, but it all sort of serves to provide a tailwind to that volatility or those wild BMW prices, I guess.
There's a lot of embedded questions in there. So we trade zero data expiration options. I've been trading expiration options for 25 years. So that part isn't new. The volume is insanely new. It's all crazy. The fact that you can do it on a daily basis in the indexes is very new. I think it's great, to be honest with you. And I don't feel at all that it's the systemic risk that I've seen in the media for a variety of reasons. I think that if you look at the hedge book and the market makers that are their counterparties for this stuff, in general, they're going to make money from it. And the chances that you are going to buy 1 million options and you're going to simultaneously wreck Susquehanna, Wolverine, Virtu, Citadel, and everybody else, it's just never going to happen.
Yeah.
Those guys are hedged to other parts of their book. And the chance of you getting all of them at the same point and just wrecking the entire landscape, I just don't see it.
Yeah, and the JP Morgan study itself that they were talking about is they basically locked the market and assumed that no one would ever take off any of their exposure. And I think that is wholly inaccurate, because if you're sitting here and the market's down 3%, you're going to start closing some puts. At least some people would, right? And
yes,
that would really, kind of kind of back to what you're talking about before, where you're in the pit and people are going to cover. That there's going to be a cover scramble there, which is the main reason that I thought the JP Morgan thing didn't make a lot of sense.
And by the way, I think that I don't usually talk about the pit that much, but a lot of the trade logic really does apply. So if you think about, if you're in the pit and you have $1 million in your account and that's all you have, right? And you're getting close to your, it's a problem. You might get fired or whatever else. What do? Well, in real life, what happens is dudes just leave the pit. And the electronic version of that is they just pull their quotes or they widen their spreads such that they don't really trade. And that's just the electronic version of literally leaving the pit.
Yeah, it makes a lot of sense. It's just done electronically. On the screen here, and I don't know if you have any insights on this. This is kind of a little bit of a curveball question, but the white line, while there's a lot of noise here, the white line is zero DTE volume as a percentage of SPX. So, it increased significantly in early 2022 as I think it was the Thursday or Tuesdays were announced first, and then the Thursdays, whatever. So basically by October, we had, full daily expirations in the SPX and full daily expirations in the SPY and the Qs. One of the things that I think is interesting is that the percentage of volume has been very stable. And I think only once it's broken kind of the 50% of volume level, as you can kind of see here with the white line. What's interesting to me is there was this very rapid adoption of the zero DT in terms of it became almost immediately upon launch, 40 to 50% of volume, and it's basically stayed at that level, which tells me that, whatever the use case for this, if there was any edge to how people were trading or use for how people were hedging or whatever it may be, right? That hasn't expanded, right? So what do you think is the prime use case for zero DTE? Do you have anything to make of the fact that, it's been very stable in terms of its utilization? Kind of how do you look at this in general?
Yeah, I can answer all that. So I think that if zero DTE, the fact that it became a everyday thing when the market was coming off of a drawdown is very relevant, because, sticking with the BMWs, if you have a BMW and it's brand new and it's nice, you buy an insurance policy on it because you don't want to lose all your money if you crash it. If you have no BMW, you're not going to pay premium for the insurance because you have no BMW to insure. So if you have de-risked coming out of COVID and then the market drawdown in 2022, and then your puts aren't also working, so your insurance policy isn't paying you and your BMW's crashed, well, I don't want to have anything. This all stinks for me. So then what happens is then somebody comes out with a, 1-day option in your BMW insurance policy. You're like, well, I got a new car. It's not as good as my old one. And it's, because it's cheaper, but I
Yeah.
don't want to commit to it. I'm going to rent this thing, but I got to rent insurance for a day too. So it's kind of a, stick your toe in the water way of having some exposure to the market. So if you are an institution and you are charged with a benchmark and you have to be a participant in NVIDIA or Qs or SPY, and you see this thing going up every day, but you see the macro backdrop, which is probably bearish. So now you have to make a decision. Do you want to take your, $1 billion of risk and put it all on SPY? Or do you want to take $1 billion of notional risk and break off, $2 million and get a similar notional exposure, but for a very small time slice? Right. And it's kind of like what I'm saying, you're getting a similar exposure, but with way less risk. So if your macro thesis does work, which is to say you think the market will go down, then you don't, just get clipped, and it's not a career-ending decision for you. So the confluence of zero DTE coming into existence at the same time we're coming off a market drawdown took us to that ascension in volume. And why is it tapered off? Well, because when you're coming from a higher VIX, you can go out and bang out a Condor or an Iron Fly or something like that. You can sell this. You can sell the premium. There is a natural decision, and there is a mathematical justification for doing that. But now that vol has come in so much, it's gone from being probably a profitable trade to really just a coin toss. So do you know if the market's going to go up or down 1% today? I have no idea. So if the straddle is rich, you can say, well, the market might move 1%, but I'm going to collect 1.2%. And I'm going to get my edge. But now it's kind of like, well, I don't know. And then the straddle's priced accordingly. So it's much closer to fair now. So the economic incentive for you going out there and banging out a bunch of iron flies or the other way around is just kind of like, it doesn't really matter. Right. So that's why you don't see more people, more participants coming into it, because there's really no economic justification for doing that.
Yeah, the margin for error now is kind of one of the things I try to talk about a lot. The margin for error now in the zero DTs is very small if you're trying to sell them.
Right. So if you look at like right, if you look at a 100 standard deviation condor in the zero DTEs in a $1 wide wing, you used to be able to collect something like 50 cents. Now your 50 cents is something like 22 cents, 23 cents. So you're talking, half the premium for the same risk. So with that, how many more are you going to do at that same level? I would argue you're not going to do any more.
Yeah, it's great to hear you kind of echo that. Because there are, and to your point earlier too on the strategy selection, I talk to a lot of people like this is what I do. I sell zero DT every day, and it doesn't, that doesn't change, and that just always felt like kind of a recipe for sort of disaster here. On the topic of the zero DTEs, I mean, it seems like, and I've been looking at this for forever and running all sorts of different studies and ways I can look, and there's a lot of things that I can say, I could put an X on the map and be like, look, right here is where zero DTEs were launched, right? And that's true, but there's also a whole bunch of other things that occurred at the same time, right? From the yes. macro landscape in particular. But there's a lot of things that just seem like, look, we have this bizarre, some of these weird anomalies, right? Like, that the skew index coming down or correlation dropping, all those things. Do you think that zero DT has a lot of impact on that? I mean, I think one of the things is like, the tenor's been pulled forward, right? So you can hedge on zero DTs rather than 1 month or whatever. Do you think that there is that kind of reverberation, so to speak, where zero DTs are affecting the way that, volatility has worked, so to speak?
Yes, I do. I don't think that like there were, 10 units of risk in the marketplace, and then 5 of them have been pulled into zero DTE or very short tenor options. Mm-hmm. I think that the overall pie has expanded so that because there's less dollars involved, but I think that some of that has moved into the very near term, and it has had an effect on all things that we just discussed, like skew, correlation, all these things. And I think that the new baseline, until a whole new cycle of suckers are introduced to the table, will be lower until everything retips. And I think that your assessment that there's a cyclicality to volatility is true. And I think it's true because of human behavior. Again, a whole new crop of people need to get wiped out yet again for a new crop of people to like, well, I got blown out selling volatility, so I can't sell any volatility. So then the guys that understand it better do sell a bunch of volatility, and they make money for 2, 3, 4, 5 years. And then everyone else piles on if they see it working again. And then a whole nother new crop of guys get wiped out yet again.
Right, right. It's that behavioral factor, I guess, that I've always thought is the most exploitable for a retail trader. I
Yes,
don't. I think I have very little edge attempting to pick direction necessarily better on a lot of times, or certainly valuation. What's Apple's valuation or whatever. But you
I
know,
have no idea.
knowing when people are freaking out is much more easy to identify, I think.
Yeah, sticking with the pit analogy, I mean, if you know the guy next to you has $1 million account and he's down 900 grand, well, the end is near. He might not blow out that day, but
Yeah,
he doesn't have another $1 million behind him. So using that information, you can then basically force him to blow out
yeah, yeah. And
if you're that cold hearted. But I'm just saying, like, you have information now that really nobody else has. So when you have an XIV and they have to go out and buy $400 million of notional, but there's not that much notional in the market.
right.
So you're like, okay, well, their NAV is 80. It's going to be 80 cents. So I'm going to just wail on these futures until, these guys are just no more.
Right.
And that's exactly what happened.
Right. Right. It's fascinating, and it's worked that way for eons, I guess. Push somebody's position against them. Last kind of question on this zero DT topic, and again, thank you so much for just fielding all of my rapid fire questions at you here. One of the other things on the zero DT space that I thought was interesting is that this is when the banks blew up. The regionals, so to speak. Well, not so to speak, it was the regionals. That zero DT flow seemed to really subside or pull back at that time. And it seemed like suddenly the shift was, okay, I need to hedge, I need to own some hedges here, right? Like tail risk is back in the market. Or maybe I just want to own, Vega in this case, because maybe, things are about to really, get a little bit weird. Do you think that sort of, we hit this point where we go from, shorter duration, whether you want to call it gamma hedging or measuring my deltas, to like, hey, I have volatility finally to worry about? Is that an imbalance that you think could really, materially shift things in this market? Is there an embedded risk in there, I guess, from a volatility cover, so to speak?
Again, I'll go back to the concept of, what are you hedging against? What do you have? What is your book? And if you have a long equity book and you either want to lose less or make more, you typically will expect to express that in some kind of a convex, instrument like an option. Yeah. And the options, they shift in time as a function of where they're, best used. So if you think that the contagion of a regional bank could potentially spread to, federal banks, not federal banks, but large banks, money center banks, and like they did in 2008, then that's not that much of a leap, especially for anybody who traded through that period in 2008. So the memory of that is, pretty clear for a lot of us. And like, I did really well in that period of time, but not by buying volatility, but by selling volatility. So I think that a lot of people, then they had these, short, keep me busy ideas like zero DTE versus like, this is actually my real book over here. And I need to figure this out right now, because I don't know if this is going to, become a problem writ large for the marketplace. Yeah. And I don't think anybody knew. And it became isolated to, a handful of banks. And actually that speaks to the dispersion trade. Like we had puts in SVB. I had no idea that SVB was going to go out of business. But one of the reasons that dispersion trades work is because you screen for cheap options and you just have them in the book. They're just on the shelf. And every now and then, and it does happen every year, you get 3, 4, 5, 6, 7 of these things where you just get lucky. One of your names gets taken over. One of your names falls apart, whatever, weather happens, there's a natural disaster. Something goes outside of what the options market was pricing. And that's another reason those books work.
So the current dispersion trade is still kind of long equity volatility, just to put a label on it, equities and short index, right? Can you break down a little bit kind of what a sample book would look like?
Well, it's like saying apple pie, right? Well, what is apple pie? Well, it's, flour, sugar, salt, apples, cinnamon, whatever, butter. But I think we can all agree that, there is a wide spread in apple pies. Like grandma's apple pie tastes different than, the one you get at the mall. But they have the same stuff, but they're not the same. So you can have a dispersion book that is very different. I have 4 or 5 different dispersion guys in the last week, personally, just guys I know, and they're down. And we're not down this year in dispersion. We're doing just fine in it. And I was really surprised that they were down because of other different reasons. So my point is that the book can be generally constructed very, very similarly, but the execution of it and the way it is implemented can be actually quite different. And those details really do bear out in the P&L.
Right.
But to super duper answer your question, though, yes, is the answer to your question.
Yeah. So
Generally
it depends on the
speaking, that
weightings
is
and the like, I guess. And that was
right.
going to lead me sort of my next question. What, if anything, would cause a sort of reversal in this? I mean, you just said a lot of guys aren't doing that well, but let's just use the SIBO index here. We had one of my friends, Emron, was talking about, well, earnings is, one of the reasons that correlation could be getting pressed lower and things like that.
Mm-hmm.
Is there a point here where you start to sort of flip that book around and say, okay, rather than sort of just as a blanket statement saying, let's be long equity vol versus short index vol, is there a trigger point for turning that around? And do you think we're kind of near that?
So yeah, I think that earnings usually are a correlation suppressor because, look at Google and Microsoft, right? One goes this way, one goes the other way, right? What does the index do? Nothing. And that's the dream, right? You're long volatility in two constituents. They both go crazy and the index goes nowhere and you make money thrice, right? Because you're short vol in the index and whatever else. So earnings do often have that effect on correlation. Now the core 3M or the core 1M is 50 stocks. Right. We don't really look at it that way. We look at the whole index and then we apportion things in our own specific way. And what the SIBO does is a lot more just formulaic, as it should be. They're an exchange. They're not a hedge fund. Right, exactly. So I'm not knocking on the SIBO at all. That's the product. They're just trying to give you a quick and dirty way to see where these things are. But that doesn't really mean that that's your trade, right? So, but to go to when do you get correlation the other way? It is a easy question with a very difficult answer. When is it good to own straddles? Well, it's good to own straddles when they break their straddle. Who is going to sell you the straddle that breaks? Nobody, right? Nobody's going to hand you free gamma. So if you buy a straddle for $10 and you can scalp, long or short your stock so that you break even every day at the straddle break even point, then you go home and you've lost nothing. You have free optionality. Nothing has happened. You've covered your theta and somebody sold it to you for fair. So that's a problem for the people that sold it to you. Mm-hmm. So the best trade for you to have on as an options trader is for you to be long a bunch of gamma and it just goes crazy. Mm-hmm. Problem for the other side of that trade is they've lost money on that. So nobody is ever going to give you a straddle that performs. Nobody's ever going to sell you gamma for less than they think they can collect for it. Same thing happens in dispersion and correlation trading. No one's ever going to sell you a bunch of volatility in anticipation for an event where correlations go up.
Right.
They will sell you at best what is fair now.
Yeah, that it makes intuitive sense, and that's kind of that's the way that it works, even for single stock, right? Fair value is what someone else
you have to be able to project forward volatility so that the current hedging regime is different. So if you're hedging on a 12 vol now and you've projected forward volatility to be 16, and then you are hedging on the future vol of 16, that is a correct way to do it. It's hard to trade in real life though.
Yeah. So that I guess is what the true question is what is sort of, or do you anticipate that there's something here that makes that index vol kind of reprice, slightly higher, shift back?
So the question really is, what is the future? And the future is whatever, it sounds like a smart ass answer, but that's really what it is. Like, what's future vol going to be? Well, the known knowns are kind of all known right now. We got our FOMC, we got our GDP. We know nothing's going to happen except for a few more data points until September. That's already been kind of like wishy-washy telegraphed. And, absent war in China, whatever else, and that everyone throws it out, but it's true. Absent some new news,
right? Stuff's
pretty fair.
Right. That's a very pragmatic view there. So thank you for that. We are already at the top of an hour, so I want to be very respectful of your time. If anyone does have a question, I know people have not put in questions yet. You can put in questions if you want now. Do you have, sort of as we pivot away here and close things off, do you have any trades that you think about saying like, hey, as a retail trader, these are the types of trades that I think are where you should sort of focus? Any kind of insights or advice you could offer to people? I mean, we have a lot of, we call pro-tail traders here, professional, retail, a lot of people making their own living, obviously trading here, but don't have, they're not on a desk where they're getting a lot of the information flow and things like that. So are there certain pockets of the market that you like now that you say, hey, this is really interesting for that community?
Well, if you look at cross asset vol, you look at gold vol, you look at oil vol, you look at FX vol, you look at really rates vol, which is so important. A lot of it is still tradable. So there is plenty to do. I tend to like range bound delta neutral trades this year, something in the ilk of a strangle or a condor. But with vol low, you probably have to go into a little bit more niche trades. So instead of banging out strangles or condors in SPY or SPX, maybe you look at something with a higher relative and absolute vol, like a Russell or something like that. I think that there's some action to be had there, because if you look at the spread between what has performed and what hasn't performed, something's going to give, right? These things that are, or these traditionally fairly tight spread trades that have now widened out. Well, either the top's going to come down or the bottom's going to come up, or they're both going to meet in the middle. Who knows? But I think that there is still some volatility in risk-defined structured ideas. And is there edge there? No, I never think a trade is edge. That's just a trade structure. But I think that you can make money in that because of the function of time.
That's a great answer. Thank you very much for that. And it makes certainly a lot of sense. All right, we buzzed through an hour. I appreciate you very much taking the time to handle all my rapid fire questions. If people want to get in touch with you as we kind of wrap things up here, you're at Noel Convex, right, on Twitter. I recommend everybody kind of check out your Twitter page. I'll try to bring it up so you can see it. Anything else? Any other ways people can get in touch with you? We do have a lot of people here who do allocate money to funds and things like that. So, what's the best way to get in touch?
Website or Twitter. I only have like 3,000 Twitter followers or something like that. So, it's not like everyone gets buried in the noise, because I don't even have that much noise. But if you want to get in touch with me a little more seriously, the website is a fine place to do it.
Noel, can't thank you enough again for taking your time here. A lot of amazing comments here, so people really appreciate it. And I look forward to talking to you again soon.
Thanks for having me.